Advanced Financial Accounting. In this presentation, we will work a consolidation process where we have a parent-subsidiary relationship, the parent owning 100% of the subsidiary. We will be dealing with goodwill within this consolidation process as well as other intercompany transactions. We'll be doing this as of year zero. In other words, the purchase is going to take place in year zero. We're going to do the consolidation basically right after that purchase point. Therefore, we're not going to have basically any income statement or temporary accounts that we will be dealing with as we concentrate in on the kind of new factors here being goodwill and some intercompany type of transactions that we need to deal with. Get ready to account with Advanced Financial Accounting. Here is our information on the left. We have P purchases 100% of S outstanding common stock for $322,000. P purchased S bonds at par value after stock acquisition for, should be stock acquisition for $65,000. So we have an intercompany transaction with regards to the bonds. And we also note that S owes P $11,000. So we have another kind of intercompany type of deal that we'll have to be thinking about, and we're going to add some more of these as we consider our consolidation process. So book value and fair value of S assets and liabilities are the same at the date of acquisition. So in other words, if we take a look, and this will be the date of acquisition, so we got P's books, we have S's books over here. We're saying then that no time has passed from the point of consolidation. We're going to say that basically the consolidation or the purchase took place. We're doing the consolidation right afterwards. You can tell that because there's no income statement accounts down below. We're not dealing with the income statement, so it'll be a bit more simplified in that fashion or in that way. And then we're saying, okay, if we took the book value and considered the calculation of goodwill, we can then just take these numbers for S over here and say, all right, well, if I took obviously the assets, 23,000 plus the 46,000 plus the 85,000 plus the 281,000 minus the 79,000 minus the 26,000 minus the 102,000, you would think that that would be the amount that you purchased for if it was purchased basically at the book value, right? But that's not the case in this case. It doesn't necessarily have to be. But you'd also say that did they have to revalue anything? And we're saying we didn't revalue anything here. We didn't revalue, and of course that amount here is equal to the equity section, which would be easier to calculate most times, right? 151,000 plus the 141,000 minus, in this case, the retained earnings, 64,000 is the 228,000. So they didn't purchase it for the same amount as the book value here. However, why would that be? One question would be, well, do we have to revalue any of these assets for a fair market value? The problem is saying no, all these values are the same at fair value and book value. Then if we compare the purchase price up here, we'll say, well, why didn't we purchase it then for the same value as the book value if the book value is the same as the fair value? In other words, the question that should come to mind is like, well, if I fair valued all the assets minus the liabilities, how is it possible that the purchase price wasn't for that amount if I did a proper fair value evaluation? Why? Because there's something not on the books that is intangible. Intangible asset, we're calling that, of course, goodwill, something like the brand name. So we're going to say, here's the book value and the fair value. Then compare that to the purchase price, the $322. That means we have goodwill. So goodwill is one of the things that we're going to have to be dealing with, as well as the intercompany transactions. We're then going to add these up. So we got P, we've got S, two trial balances. We will then add them up. So here's going to be our sum on the right. And then we have, of course, our investment here. That's going to be one of the things we will have to eliminate now in our elimination or consolidation entries. So within the consolidation entries, let's say, okay, now we've got this investment in S. It's a straightforward type of investment at this time because we're consolidating right after it took place. So even though we're assuming they use the equity method, but there's no activity since the point of purchase, so it's just on there at the purchase point. Now, once again, you may want to think about this as one long journal entry. I'm going to do this in a piece-by-piece method again, so that we can break out these long journal entries into component parts. I think in practice, oftentimes, it's actually easier just to do one long journal entry, but the component parts can be useful too. So I'm going to break it up a bit. So we're going to be removing the investment. Notice I credited the 228. I want you to imagine right now that I didn't put the 228 right there. We just know that the investment's going to go off the books. This will basically be our plug after we eliminate the other half, which is going to be down here in the equity section. Meaning we need to remove the S's portion of common stock, additional paid-in capital, and retained earnings. So I'm going to record that out for now. We're going to say then the common stock is at the 151. So 151 we are removing. Here's P's portion, here's S's portion, there's the total. Then we're removing the portion for S, bringing us back to P. Then we're going to do the same thing for the additional paid-in capital. So here's the additional paid-in capital. It's a credit for S. We're going to debit it to remove it. So then we have the total here. We removed it. So now we're at P's additional paid-in capital. Then we have the retained earnings. So here's the retained earnings for P. Here's the retained earnings for S. Happens to be a debit in retained earnings at this time. Therefore, the total's the $310,000. We are then removing S's portion of it to bring us back to the portion for P. So now I want you to think about up here, if we took the 151 plus the 141 minus the 64,000, that's where we're getting this 228. So this is like the plug. This is like the plug here. We removed, in essence, the equity section. We're putting the other side to investments. No activity has happened, therefore no income statement accounts that we have to be dealing with. Normally, if our assumptions were the same as prior presentations, in other words, if the purchase price was for the same amount as the fair value and the fair value was the book value, then this number would be the same as what was in the investment account. However, it's different now. Why? Because we had goodwill. Therefore, we're going to plug this in first. That'll leave us with the 94,000. What was that 94,000? Where did it come from? It's the goodwill that we calculated. So, and it's only the goodwill this time. Notice what it could be. You could say, well, it could be the goodwill, and then it could be the difference between the fair value and the book value. But there was no difference in the fair value and the book value in this case. Therefore, the difference is goodwill. We're not going to have to revalue the accounts. We're just going to say the difference was the goodwill. So we're going to say, all right, now goodwill is going to go on the books, this intangible asset. So there's the intangible asset that's going on the books. What is it? Some intangible thing, probably brand name. People have confidence in this company, in S and what they do. Therefore, the earnings are going to be higher than just simply the net assets of the organization. The other side going into the investment in S. So the investment in S now going down to zero. That's what we would expect. So that's going to be our standard kind of adjusting entries that we have there, or our reversing entries in the case. And notice it's a little simplified because we don't have the income statement accounts here. However, now we have those intercompany transactions. So what happens if there's kind of intercompany transactions that are going on here? So we had the bonds that were on the books. So for example, if we look here, we say, hey, look, there's investment in S bonds here. So how can P invested in the bonds issued by S? Well, we can't have that, right? Because that would mean that P owes S. And when we consolidate them together, they're the same entity. Now, that should be a fairly straightforward thing to remove because we would see it on two sides of the books. One, it's here for P, and it's going to be in here for S, you would think, right? So we could just remove both of those sides. Notice it's not a huge deal because when we consolidate it, you'd say, well, it's not a big deal because it's right here, and then it's like right here, and they're going to net each other out anyways. But it's still a problem because, of course, the assets are overstated and the liabilities are overstated. The net of the two will wash out, but we need to remove them. So we're going to say, all right, let's remove the bonds here, and then let's remove the investment in. So then we remove the investment in S. So if we remove the investment in S, then that's going to be going back down to zero. So the next thing that we have then, we've removed that intercompany transaction. You'll recall, I believe it was that in the instructions that S owed P, I believe is the way it went, S owed P. So if you think about the normal kind of business transactions, if there was a business transaction, for example, if P was to issue an invoice to S, then you would think, all right, well, then that would mean the accounts receivable includes in this number something that's owed to P from S, which doesn't seem proper once we do the consolidation. And on the other side of things, in the accounts payable, you would assume that the payable for S's books would have something in it that is owed to P, and they should be washing each other out. So again, you might say, well, it should just kind of wash each other out because that means that the accounts receivable would be overstated and that would mean that the accounts payable would be overstated, but the net of the two for the net assets would wash out, but we want to remove the two overstatements. Now, how would we know that those were there? Well, if we looked at the subledger for P, breaking out the accounts receivable by customer, we should then be able to see the customer of S and see that amount that is owed to P from S. And on the other side, on S's books, with regards to the accounts payable, we should be able to look at the subledger, breaking out who S owes by vendor, one of those vendors being P. Those two things should be equal and opposite, allowing us to do the journal entry, which is going to look something like this. We're going to take the accounts payable here. It's got a credit. We're going to do the opposite thing to it, debiting it to make it go down. And then we're going to take a look at the accounts receivable. It has a debit balance. We're going to make it go down by doing the opposite thing to it and crediting it. So we've got those transactions, intercompany type of transactions that should wash out. Then we got our standard kind of depreciation transaction we saw in prior presentations. You'll recall that this accumulated depreciation for S at the point in time of purchase, we want to net in and just report the book value at that point. Now note it's been a year later, so or actually this is the same year. There has been no activity, so that's 79,000. We want to net into the 9 or the 281,000. So we're just going to say, all right, debit the depreciation expense, just like we've seen in prior examples for that 79,000 of S's accumulated depreciation, and we're going to net it into basically the building and machinery. So instead of reporting these two amounts as building and machinery, PP&E, property, plant, and equipment minus accumulated depreciation, we are in essence going to net them together in the consolidation as we have seen in the past.